Welcome to the deep dive. Today, we're doing something a bit different. We're actually going back in time, digging into, well, what might seem like a pretty dry document at first glance.
Right.
Markel's 2004 shareholder letter, nearly 2 decades old.
Yeah, it doesn't scream cutting edge, does it?
Not exactly, but honestly, I think you'll find this is surprisingly fascinating. It's packed with insights that feel really relevant today. What first struck you about it? Why this letter?
Well, the financial world often feels like it's chasing the next new thing. But what's so compelling here in this 2004 letter is how it just lays out these, foundational principles for long-term success.
Mm-hmm.
It's much more than just reporting numbers. It's like getting a peek under the hood of their whole philosophy, how they think about building value, navigating the bumps in the road, especially in insurance, which is, let's face it, pretty volatile.
Absolutely. And that philosophy, that consistency, it really starts with who they are, right?
Yeah.
Their core identity.
Mm.
They were actually heading towards their 75th anniversary in 2005, founded way back in 1930 by Sam Markel. I mean, just think about sticking around that long in business.
It's incredible longevity.
It really is. But the key takeaway for me wasn't just the age, it was how those values from, decades ago were still guiding them.
Yeah.
It shows that core principles, if they're strong, they just work, regardless of market cycles.
Yeah.
They went public in '86, built this powerhouse specialty insurance business, then expanded internationally in 2000, basically doubling in size. It's this constant evolution, but always anchored.
Anchored's a good word.
Mm-hmm.
And the letter talks about the Markel style and their commitment to success.
Right.
And these aren't just, buzzwords they trot out. They explicitly connect their success. Yeah, they mention some good luck,
Yeah.
but mostly attribute it to having great people who are really focused on living these principles.
So it's baked into the culture.
Precisely. It's active. It shapes decisions day to day. It's not just a plaque on the wall.
Okay, so it's one thing to talk the talk with values, but how did that translate into, well, the bottom line? What are the numbers from back then? Tell us.
The numbers. Well, they definitely walk the walk. They reported, get this, a 24% compound annual growth rate in book value per share since they went public in 1986.
Wow, 24% CAGR.
Yeah. And book value per share, for listeners, that's basically the company's net worth divided by its shares. It's a core measure of intrinsic value. So growing that at 24% a year for, almost 2 decades back then, that's serious compounding.
Seriously impressive, especially in insurance.
Definitely.
And 2004 itself was a record year, wasn't it?
It was. Earned premiums hit over $2 billion for the first time. They had a combined ratio of 96%.
Okay, let's pause on that. Combined ratio, that's key for insurers, right?
Yep.
Expenses and claims versus premiums earned.
Exactly. Anything under 100% means you're making a profit just from writing insurance
Yeah.
before you even count investment income. So 96% is really strong. A 4% underwriting profit margin. And their shareholders' equity grew to $1.7 billion, about $168 per share. They stated very clearly their main goal was long-term growth in book value per share.
And they were hitting it.
Consistently, 20% CAGR over the last 1 and 5 years at that point, 21% over 10 years. It shows it wasn't a fluke. It was the result of a very deliberate strategy playing out.
So that consistency, achieving that kind of growth year after year, particularly in insurance, it says a lot.
It really does. It speaks volumes about their discipline. This wasn't growth just for the sake of getting bigger. It was disciplined growth. You don't get those numbers by just writing any policy that comes along.
Yeah.
It's about smart risk selection, profitability, focus. That's how you sustain excellence through the cycles.
It sounds like they really understood the nature of their business. I mean, insurance is inherently unpredictable, right? They even acknowledged that, called it lumpy.
They did. I love that honesty. They flat out say, our business is lumpy and you need to expect the unexpected. They weren't trying to smooth it over in the report.
Like in 2004, they had those Florida hurricanes.
Yeah, about $80 million in losses from those. But they also pointed out, thankfully, the storms didn't hit major metro areas as hard as they could have.
So some luck involved there, too.
Sure. And conversely, they noted the lack of major earthquakes or typhoons elsewhere boosted results. Then you had the terrible tsunami in Southeast Asia.
Yeah.
Minimal direct financial hit from Markel, but it served as this stark reminder of the kind of catastrophic risks that are always out there.
So given that lumpiness, that constant potential for big hits, how did they manage to not just survive, but actually thrive and deliver those returns?
Their core strategy, and they spell it out, is diversification. Having a large and diverse book of business across many products and locations.
Spreading the risk.
Exactly. Lots of smaller, specialized bets rather than one giant one. It helps smooth out the bumps over the long haul, even if individual years are volatile. Earning solid returns consistently in that environment, that's proof of really effective, disciplined risk management.
And that discipline, it goes right down to the operational level, doesn't it? The actual underwriting.
Oh, absolutely. Underwriting discipline is the phrase they use. That's where the magic happens, or doesn't. It's about knowing your niches inside and out.
Like their excess and surplus lines, that segment had record profits in 2004, around $148 million.
Yeah, and their flagship, Essex, was hitting its 25th anniversary, consistently profitable even with hurricane risk.
And Shan, dealing with complex stuff like employment practices liability, medical malpractice, profitable almost every single year since 1990.
Real problem solvers, they call them.
Yay.
Then you had specialty admitted, also record profits, $38 million.
That's where you find those really specific niches, like insurance for camps, daycares, even horses.
Right, the agriculture and equine portfolio. And Markel American Specialty, which was way ahead on tech, selling motorcycle insurance online back in 2004.
Bikeline.com, yeah. It's this cool mix of deep expertise in weird little corners of the market, plus some real innovation.
It paints a picture, doesn't it? This mosaic of specialized operations. It shows that deep, granular understanding of risk is critical. But it's not just risk selection. They also talk about providing safety engineering, loss control services, good customer service.
So managing the risk after they write the policy, too.
Exactly. It's a whole package. And crucially, all that knowledge from the insurance side, it feeds directly into how they think about investing.
Ah, okay, so it's not two separate businesses, insurance and investing. They're connected.
Very much so. The investment side is obviously huge for that long-term book value growth.
So how did investments look in 2004?
Pretty solid. Overall return was 7.9%. Equities did really well, 15.2%, while fixed income delivered 4.8%.
And didn't they make a big shift towards equities around that time?
They did. That's a key point. Over 3 years, their equity allocation went from 13% of the portfolio up to 21%. In dollar terms, that was a jump from about $550 million to $1.3 billion.
Wow.
And as a percentage of their equity, their shareholder capital, it went from 48% up to 81%.
That feels like a pretty confident move. Leaning more into stocks? What was the thinking there?
Their philosophy comes through loud and clear. We are investors, not traders. Simple, but powerful. They want to own pieces of profitable businesses, buy them at decent prices, and then just benefit as those businesses grow over time. They even quote John Templeton, "Share prices fluctuate more than share values."
Classic value investing mindset. Patience.
Exactly. They're not trying to jump in and out based on market noise. And you see that discipline on the fixed income side, too. They kept the duration short and quality high because they were worried about rising interest rates. That matches the insurance liabilities.
So the bond portfolio is about safety and matching insurance needs. The equity portfolio is for growth, funded by shareholder capital.
That's basically it. And they compare their returns to indexes like the S&P 500, not as a benchmark to beat month to month, but, as they put it, to demonstrate the value added by our approach over long time frames.
Interesting distinction.
Yeah. And they were upfront about specific holdings, too. Pointed out a big gain in Fairfax Financial, but also a drop in Marsh & McLennan because of the Spitzer investigation back then.
So transparency even when things weren't perfect.
Right. It shows that even with a disciplined, long-term view, you still face bumps, but their perspective lets them ride those out.
Okay, so we have disciplined underwriting, patient investing. What about the foundation, the balance sheet itself? You mentioned stability is key for them.
Paramount. Their number one goal for the balance sheet, unquestioned financial security. Returns come second to that.
How did they structure it to ensure that security?
Well, end of 2004, they had that $1.7 billion in shareholder equity. Then they had a mix of debt, senior notes, junior subordinated debentures, and some convertible notes.
They actually issued new debt that year too, right?
They did. $200 million in senior notes at 7.35%. And the reason was explicit. Lock in a fixed rate for the long term because they thought rates were heading up. Proactive risk management again.
And those other debt types, the junior subordinated and convertible ones. They mention unique features. Sounded a bit complex.
Yeah, they are a bit different. The junior subordinated debentures, or TRUPs as they're sometimes called, they're debt. But the company could choose to defer interest payments for up to 5 years if needed.
Ah, so like a safety valve.
Kind of. It gives them flexibility, makes it act a bit like equity in stressful times. Markel even counted it towards equity in their own internal leverage calculations.
Interesting. And the convertible notes?
Those were zero coupon, meaning no regular interest payments, but their value grew each year, and holders could convert them into Markel stock.
Which would mean more shares outstanding.
Right, potentially diluting earnings per share slightly, maybe 2% they estimated, but it would also increase book value per share by about the same amount because of how the conversion worked. It's all very deliberately structured.
It sounds like they put a lot of thought into the exact mix. What was their target?
They stated they believed in roughly one-third debt and two-thirds equity. That balance, they felt, gave policyholders the security they needed while still allowing for potentially high returns for shareholders.
Makes sense.
They even touched on the rating agencies having lowered their ratings after the Terra Nova acquisition due to some legacy issues they inherited. But Markel expressed confidence they'd get those ratings back up as things got resolved. Again, that long-term, steady confidence.
That responsibility theme just keeps coming up. And it wasn't just financial structure, it extended to governance and people, too. They talked about Sarbanes-Oxley, right? SOX.
They did. Section 404 specifically, and they were candid, called it complex, time-consuming, and very expensive.
Doesn't sound like they were fans initially.
Probably not. But their conclusion was interesting. They said, despite the hassle and cost, it actually forced them to improve their internal systems and operations.
So a benefit in the end.
Seems so. It shows how sometimes external pressures, even painful ones, can lead to internal strengthening. They also addressed the big industry issue at the time, the bid rigging investigations led by the New York AG.
Right, that was huge news then.
Yeah, Markel basically said, not us. They expressed confidence it wasn't an issue for them, pointing back to their core values. Honesty and fairness in all our dealings. They even quoted the Quakers, do good and did well.
So embedding ethics right into the business model.
Very much so. And you saw that focus on quality people and the leadership changes they announced, too. Daryl Martin handing over the CFO reins to Richie Witt, bringing Al Broadus, a former Fed president, onto the board.
Signals a focus on expertise and planning for the future.
Exactly. It highlights how much they valued strong controls, ethical behavior, good leadership. And remember Markel University, which they had started a couple of years earlier.
That train new hires, right?
Yeah. Investing in human capital, developing their future associates. It shows they saw their people as the core asset, the key to keeping the culture and the success going.
Okay, so bringing it all together, how did this translate into their strategy in the market? You mentioned 2004 saw pricing getting weaker in insurance, a tougher environment.
Right. After 9/11, there was a period of rapidly rising insurance prices, a hard market. But by 2004, things were softening again. More competition, pressure on rates.
The temptation must have been strong to lower standards a bit, chase business to keep the growth numbers up.
Absolutely. But Markel was adamant, we will not go down this path. No chasing premium if the underwriting doesn't make sense.
That takes discipline.
Huge discipline. Their model for profit couldn't be clearer. Underwriting profits and investment returns build shareholder value over the long term. And crucially, underwriting profits come first. Volume is secondary.
So they'd rather shrink temporarily than write unprofitable business.
That's the message. They were prepared for slower premium growth if market conditions demanded it.
So if they weren't chasing market share, how did they plan to compete and grow?
Good question. Their focus was, 1, renewing the good business they already have through great service. And they were succeeding. Their retention rate jumped from 77% to 81% in 2004. That alone added over $100 million in premium.
Keeping existing customers happy? Smart.
2, looking for smart acquisitions that fit their model. And 3, using their investment flexibility. Remember the 80% fixed income, 20% equity split?
Yeah.
They noted that if good insurance opportunities became scarcer, or if their capital grew faster than opportunities, they could dial up the equity allocation to boost overall returns.
So adapt the investment strategy based on the insurance market conditions.
Exactly. And they even mentioned a final alternative. If they simply couldn't find ways to earn high returns on capital, they'd return it to shareholders via dividends or buybacks.
Acting as true stewards of capital.
Precisely. Though they didn't expect that to be necessary anytime soon back then. It's all about that relentless focus on long-term value creation per share.
So wrapping this up, looking back at this 2004 letter, it really feels like a blueprint, doesn't it, for building something lasting.
It really is.
We've seen these key pillars, those timeless values, the intense underwriting discipline, the patient, Long view investing, that rock-solid financial footing, and strong governance focused on people and ethics.
Yeah, it paints this picture of a, well, you called it a flywheel earlier, didn't you?
Yeah, flywheel with momentum, good people living consistent values just keeps the profitable cycle going, building trust with employees, shareholders, customers.
And maybe the biggest lesson, the thing that really resonates, is the consistency. Saying these things year after year is one thing,
Right.
but actually doing them, executing on them relentlessly, even when it's tough, that seems to be the secret sauce.
That commitment to earning your trust in the years to come, as they put it, living the values day in, day out.
Exactly. That's maybe the most fragile part of it all, but also the most valuable asset they describe. It makes you think, doesn't it? How could you apply that kind of discipline, that long-term view, that ethical foundation
Yeah.
to your own decisions, whether in business or just managing your own finances?
Right. That focus on building real, enduring value, not just chasing the next shiny object. That feels like the core message that's just as relevant, maybe even more relevant today as it was in 2004.